Hey guys, today's video is about Credit Repair Secrets 2021. And when you learn about the secrets, you will also learn how to qualify for the best mortgage rates. And we will explain the credit score for you as well. So stick around because we are starting right now. My guest today is Mark Tippis, who is a good friend of mine, and he's a credit repair guy. And I brought him in today to speak to us about credit repair, teach us all the secrets, and answer questions that you might have regarding credit repair and how to fix that so you can get a great mortgage rate. So we'll go right and dive into it.
There's three, it's not accurate because there's three prongs to this situation, right? There's credit score, which your interest rate heavily relies on. There's income, and then there's assets. So all three of those impact the rate at which you will purchase a loan every single time. So you can have someone with really good credit, but income isn't that good, and then their rate will be significantly higher than someone who has decent credit and decent income.
Oh, okay, so the income will affect your credit
Of course,
percentage as well. I didn't know that. I thought.
Of course, because look, the risk of lending someone money that is using more of their monthly income towards their living expenses is higher than the risk of lending money to someone who's using less of their income towards their living expenses.
Yeah, I get that. But my personal thinking is like, that doesn't even make sense because the person's already making less money and now you're asking them to pay a higher interest rate just to pay you. It's like
yes, I agree, but
we're kicking the man when he's down, you know what I mean?
Yes, but it's also risk.
Afford it, but now I really can't afford it.
All right, so which brings us to the other side, which is okay, so if a credit score, well, I'm sure a credit score has a big impact on the interest rate,
of course,
obviously. So would that be wise for somebody to maybe spend some time to get their credit in order before they actually make a purchase?
Yeah, depends on the situation. Depends on how much money they have. Like what are they working with, right? So if you have somebody, again, let's just take a easy $500,000 property, right? Let's say you have someone buying a $500,000 single family, and he comes to you and says, I have $200,000 that I would like to use for the purchase of this property. Problem is, I have a 620 credit score, right? Now, what I'll do is, with that type of person, I can pay some things down and do what's called a FICO score simulation to see how I can get him to a 640 credit score by paying down certain accounts. And that generally can be done in 45 days. I still consider that credit repair, but I would definitely suggest for that person to do that because the rate will be so different and significantly better at a 700 credit score than a 640, 650 credit score. And then sometimes you have a client that, the next tier up is 10 points, but they're strapped for cash and they have to close, they're in a lease and they don't have the time to really fix their credit. It's not worth the expense and the time of doing that. You're better off just purchasing at the current rates and moving on, maybe refinancing when your credit gets better. So yes, generally I would say everybody should improve their credit scores before purchasing a home because your credit score directly impacts the rate at which you'll borrow money, right? But you should do that 6 months before you think about purchasing a home. The person who's purchasing a home now in 30 days, 45 days,
it's not an effect.
It doesn't make as much sense sometimes.
Right, that's what I mean. It's like prepare ahead of time.
Prepare ahead of time. Yeah. Correct.
But would there be, like, hypothetically speaking, and I know there's not, it depends on a lot of things, but somebody has a 820 credit score, versus 750 credit score or
Mhm.
780 credit score.
Mhm.
Is there really a difference in are they going to get even better interest
Yeah.
rate?
Yeah,
They would.
of course.
So even on the high end of
Even
high
the high
end,
end, even above 740 in certain loan products, you're getting a better rate.
well, maybe I should get my credit report fixed up because I'm like in the 700s. My husband's actually in over 800.
Yeah, 100%. And what's worse in that situation, what you're referring to, is that let's say you both came and applied and you're both purchasing the mortgage, right? You're both purchasing the house and getting a mortgage. I have to use your credit score, not his.
Oh.
I have to use
Why?
I have to
The
use
lower of the two?
the lower.
I'm going to be in so much trouble today because
Is he listening? Is he listening by?
not that he's passing by and he can.
You need to close that door.
Close the Bloomingdale cart.
I'm not
Bloomingdale's
afraid
cart.
Yeah. So the way it works is we take a middle score. So there's 3 credit bureaus, 3 scoring models. If you have 2 applicants, we have to take the lower middle score.
So so you don't average, or you do average?
It's never an average. It's let's say Equifax is 700, Experian is 720, and the other one is 850. It's 720. That's your middle score. It's not an average of the 3. It's just the one that lands in the middle. So when you have 2 applicants, you have to take the lower of the middle scores.
Wow, that sucks.
Well, I guess the house is going under his name.
That's it. That's it.
Just make sure you're on the
Just one
title.
person on this loan.
I don't know. I think LLCs are the best, but that's not
LLCs are
private
good.
residence.
LLCs are good, but not on private residence. Exactly.
Yes. Okay. So obviously there's certain items that could be marks on your credit report. Are there certain items that heavily weigh outside of somebody who's not paying their mortgage? Obviously, that's that. But like
Right.
other things, do they weigh more than other items on the credit report?
Yes. So what we see is the more recent a derogatory item, the more it weighs onto your credit report. So you can have a late payment that happened last month impact your credit score by 50, 60 points.
Wow.
Whereas you had a charge off for $10,000 from 2 years ago that's not impacting your credit at 50, 60 points. So time wise, the more recent that derogatory item is, the more impact it has on your report. If you were to compare all of the things happening at once, meaning like you took a credit report and you said, okay, if I have a late payment on this credit report now, I have a charge off on this credit report now, I have a collection account on this credit report now, right? Obviously the bigger accounts are the ones that impact the score the most. So like judgments, foreclosures, bankruptcies, collection accounts, charge-offs, late pays. That would be the order that they impact your credit score if they all happen in the same time, which doesn't happen, but I'm just giving you kind of like an understanding. Does that make sense?
Yeah. So in other words, the way I understand it is this: if you have issues on your credit report, and you were to choose what to fix first, if any, then take what happened just recently and fix that and forget about the other stuff.
Usually, yes. Usually that will improve your credit score faster. Now,
and how do you do that with a late payment on something? It's just a late payment.
So, I mean, with late pays, you can try to dispute the negative information with the original creditors or the credit bureaus to try to find errors, mistakes, and inaccuracies and get them to remove it. I just wanted to go back for 1 second. If you have a collection account that's reporting every single month that you owe that collection account, that is going to weigh heavily on your credit every single month because it's a recent collection account being reported on your credit.
Wow.
So I would say if you're looking at a credit report, which is, what I do regardless of which hat I have on, right? If it's mortgages or credit repair, and I'm trying to help someone quickly improve their credit score, I'm looking at, number one, the most recent negatives. So like a late payment that happened very recent, or collection accounts that are still reporting on a monthly basis onto that credit report. And that's where I usually get the most increase in credit score.
Are there any items that cannot be repaired?
Yeah, I mean, so like
Foreclosure?
foreclosures is one of them. So any credit repair is kind of tricky, right? And like people don't usually like to talk about it because
We like to talk about it.
I like to talk about everything. So any negative item can be removed and any negative item cannot be removed, right? So you can have a charge off on one particular file that is removed and then a charge off on another person's file that's not removed. You can have a foreclosure or bankruptcy or a judgment or collection accounts, charge off accounts that are removed on certain people's files and not on others. It's about finding an error, mistake, or inaccuracy in their paperwork, and no two accounts are the same. So yes, some accounts cannot be removed, but not based on the type of account it is, just based on the information that the credit bureaus, the collection agencies, or the original creditors have. I don't know if that, yes, no?
Well, for me, it's more like.
You're looking for collection accounts can be removed, charge-offs cannot.
Okay, explain the difference.
Okay, so what I'm saying is when I work on a file, right, when we do credit repair and we are looking for errors, mistakes, and accuracies to get it deleted off the report, it's like a needle in a haystack, kind of, right? I have to find the error, mistake, or inaccuracy, and then I have to force them to delete it, right? So there will be in every single file that we work on accounts that are not deleted from the credit report.
Because you can't find the mistakes or the
you can't find the mistake, inaccuracy, or error. They're not removing them. So it could be a late payment, it could be a charge off, it could be a collection account, it could be any type of account. But on the flip side, I've removed every type of account in the past. You get what I'm saying? So it could just be like you get a client that has charge-offs and bankruptcies, his get removed. The next client, collection accounts removed, but charge-offs don't. You can't say one account, any one particular account cannot be removed. Now, judgments, bankruptcies, and foreclosures are the hardest accounts to remove.
But they do eventually go away with year times, right?
7 years from the date of last reporting. That's very important.
Oh. Wow.
So then 7 years really doesn't mean 7 years. If somebody you have a problem with or a credit card with, say, and you don't pay it, but they keep reporting it, even after 7 years, it doesn't come off your credit because it's still being reported.
Correct.
Wow.
It's 7 years.
Not just the foreclosure, like you said. It's
everything.
Okay.
Everything. So late payments is 2 years, because we don't look past 2 years on the report. But everything else is 7 to 7, and bankruptcies can even go longer, 10 to 12 years, depending on the type of bankruptcy, how many times you filed bankruptcy, and so on. Yep.
So what, just like an estimation, what's a foreclosure? I think a foreclosure is like 200 and 250 points?
Oh, I have no idea, honestly.
Oh, okay, because I was gonna say, for
Very
example,
hard to say.
okay, if somebody has a foreclosure, but everything else is good and could their credit be 650?
Yeah.
So, but then.
And we can do loans on foreclosures and bankruptcies after a certain time frame.
Okay, so what is an estimated time it will take to repair someone's credit history, like on average?
45 days and up to a year.
Really? Wow, depends on the item.
Depends on the situation.
Yeah, it
Everything is
depends how bad the
situational.
credit is.
It
Because
depends
you need to kind of like look for the needle that you're
in the
looking for.
haystack, right?
Yeah.
And it also depends on finances. So I'll have clients who say, okay, you know what? I have $5,000 that I can work with to pay some of my bills down. What should I pay to get the maximum increase in credit score? So we'll do some of that. We'll do some removals of negative information. Like the thing with credit repair is, and how I focused on credit repair was always, there's three aspects to improving credit score. Number one is negative information. So trying to delete as much negative information as possible. Number two are collection accounts that are unpaid. So any collection accounts that are unpaid are impacting the credit score. So settle the ones that improve the credit score the most, right? And number three is utilization, or how much of your credit cards you're using at that time that your credit is ran. So if you fix all three of those things, like you bring down your utilization a little bit, you settle some accounts, and you remove a little bit of negative information, you should be able to qualify within a 4 to 8 month time frame.
4 to 8 months. Okay, so yeah, that was a good touch on the credit. How does that credit cards? I mean, how does that? I mean, if you, let's say you have $25,000 expense limit on your cards, and let's say you have 4 or 5, right?
Mhm,
And
mhm.
let's say you really don't use them or use very little. Does that affect? Should you close the ones you don't use?
Definitely not. Never close any credit cards.
Yeah.
Never close any accounts. Forget about credit cards.
Really?
Anytime you close any type of account on your credit report, your credit score will suffer.
Mm-hmm.
Auto loan, credit card, installment loan, anything that you close, mortgage, anything you close, your credit score will suffer.
Paying off your mortgage is not a good idea?
No, not when it comes to the credit score.
Well, how much points are you?
Why?
A
That's
lot.
weird.
You can lose a
Well,
lot.
how do we know why? That's the rules, but like what?
I know why, but it's because so credit scoring is an algorithm, right?
Mm-hmm.
And it's like a math formula. So if you think about 2 plus 2 plus 2 plus 2 plus 2, right? Now, if you close something, that 2 that you had there is no longer
Goes
there.
away.
It goes away. So what happens is it drops out. Now your score is less. Over time, your score will build back up because it's using the information it does have, which is positive. But in the short term, it will negatively impact the score. That's why any lender, any good lender, will tell their clients while they're in the purchase process, do not open any new accounts and do not close any accounts, because that can significantly impact your credit score.
But not utilizing, let's say the credit is not.
It's not a bad thing. Now, if you have all credit cards zero balance, what I've seen is that the credit score could actually be lower because there's nothing for the scoring algorithm to score. So you want to keep a small balance.
Spend money. That's it.
That's it. We're just trying to get you guys to spend money.
It's true. It happened to me. It's true. I swear to God. I paid off all my cards about 6 months ago and my score dropped like 20 points.
Yeah.
I'm like, I'm trying to build my score by paying these off.
Yeah.
I left the cards open. I didn't close anything because I knew, you know, you want to have that available credit. So
Of course.
pushes your, what is it, your credit to debt ratio?
Yep.
It keeps it up.
Utilization ratio.
Yeah. So I
Yep.
didn't close it and my score dropped 20 points.
Yep. Because all of your cards were at zero. Now, if you were to put a $10 charge on any of your cards, you would have seen an increase in your credit score.
So just
Crazy.
go buy coffee on each
That's it.
credit card once a week.
What you want to do is, so credit cards report on a monthly basis. It's a little bit outdated because if you pay something off, you'd think it should report onto your credit report as such, right? Your balance is now whatever, less.
Yeah.
But what happens is that every single credit card, every single financial institution has a specific reporting date. And every month, whatever your balance is on your reporting date is the balance that will be on your credit report for the next 45 days.
Mm-hmm.
So one way to trick the system is to find out from your creditor what your reporting date is,
Oh.
pay your balance 3 days before the reporting date, and you will always have a low balance on your credit report that you can use however much you want.
So how much does it cost to hire
credit
you, for
repair?
example, for a credit repair?
So most credit repair companies charge a monthly fee, but they only work on a limited amount of negative items. So they'll charge like $120 a month. They'll work on 2 or 3 negative items. Next month, 120, 120, 120, 120. I don't like to work like that because I like to tackle all the negative information that's on the credit report from day one. So we have a initial audit fee and then a deletion fee. Our initial audit fee is between $395 and $595, depending on the credit, how much negative information, whether we're doing a FICO score simulation, like we have a few extra products. And then we charge $50 per deletion after the negative item is removed. So it's performance-based rather than just a monthly fee.